Thanks for joining us today on Market Call. I'm Morella Fernandez. Rebecca Teltscher with us on the show, portfolio manager at Newhaven Asset Management. She'll take your questions today on Canadian stocks. Here's how to reach us. 1-855-326-6266 if you'd like to dial in. You can email your questions to marketcall@bnnbloomberg.ca. Good to see you. Thanks for coming in.
Thanks for having me.
You see a lot of risk for the market. Name one or two for me.
We'll
keep it to one or two right now.
I know. I could go on all day. I would say, geopolitically, I think that's very clear. One day the war feels like it's back on. The next day there's a tweet that says otherwise. And so it's hard to tell where exactly we are. All I know is I think that clean exit that, Trump and the market is anticipating is going to be harder than expected. I don't think we're going to get to a situation where the Strait of Hormuz is just going to get open and all those vessels are going to get through on day one. So I think it's going to be a little bit more nuanced and more time. So I think the market is not pricing in that risk. I also think that, there's a disconnect between the bond market and the stock market right now, which is clearly pricing in higher inflation. We saw last week in the US, there was a very disappointing or a very strong inflation number. Canada today, less so, but that's mostly from, lower rent prices. But, if we're looking at food inflation, if we're looking at obviously the price of gasoline, their inflation risk is on the rise. And then the ability of central banks to be able to react accordingly is difficult right now. I wouldn't want to be in any central bank's shoes because on one hand, you see employment numbers that are not great. You constantly see the data being revised downwards for previous months. I mean, we're looking at a situation where employment is not at its peak. But then you're also seeing inflation risks coming back. And so whether central banks are going to raise or cut is up in the air right now.
Why do you think that investors are looking past the energy woes specifically? It's been going on now for several months. As you mentioned, there is no clear exit, hasn't been a clear exit strategy even. So why do you think investors are okay looking past that?
That's a phenomenal question. I wish I had the answer to it because that's obviously not how I've been investing my portfolio. We've been investing more conservative. We always like to think, what's the worst case scenario? What if we get it wrong? For us, we focus on preservation of capital. So that initial investment, we don't want to get it wrong. We're not going to take any speculative risks. The market, on the other hand, seems to be having a mind of its own. What I would think is, concentration risk is very skewed right now in the United States. I mean, technology accounts for almost half of S&P 500 if you include, like Amazon is technically a consumer stock, but I would consider that more of an, IT. Same with like Meta's communications. I also consider that more of a tech stock. And if you think about chips are about 18% and represent half of the gains in the S&P 500. So if you look at the indices as a whole, the NASDAQ, S&P 500, it's telling one story, but it's telling basically a specific story of a specific sector of stocks.
Okay, let's take a quick break. We'll get to the phone calls and the emails for Rebecca Teltscher, Newhaven Asset Management. Again, she's taking your questions on Canadian stocks. We're back in a moment. Welcome back to Market Call. We're going to start with an email from John. He says, what does your guest think about Rogers Communication stock, RCI-B, for the next 2 to 4 years? Our guest is Rebecca Teltscher, and she joins us now. Rebecca, what do you think about Rogers? I know they're all in on their sports business right now. Is there money to be made there?
Yeah, I mean, first, I'm going to say I commend the writer of the question of having a time horizon of 2 to 4 years. Like, that's a nice time horizon to be able to get an idea of what, a company is doing for the medium to longer term. I most often get questions where the time horizon is, 1 to 6 months, and it's hard to know. So for Rogers, it's actually outperformed the other telcos. I mean, BCE and TELUS And there's, pros and cons. I have nothing against Rogers. We don't own it. We actually own the other two that have performed more poorly relative to Rogers for different reasons. We prefer the dividend yield in BCE and in Telus. Telus, we feel, is performed very poorly, but actually we feel has the most, growth ahead of it in terms of a turnaround story, new, management team, and more further ahead there, of the CapEx program, the fiber to the home build. But I think with Rogers, there's this anticipation that there's going to be a media spinoff, as you mentioned, with the sports. And I think that's to, extract some value. And I think there might be some short-term investors that are in it, just for that spinoff. As a long-term investor, we prefer Telus. That being said, I don't think you can go wrong on any of these telco names because I do think that all of them are not getting any love right now. The promotional environment has not been great. There are periods of time where the promotional aspects are a little bit better. They play nice right now. They're trying to undercut each other on prices, which is not great for their bottom line. But at the end of the day, we like the defensive and the critical infrastructure that they bring to the table. So we like the sector in general. It's not a high growth sector. It's more of a yield sector. And that's why we prefer the ones with a higher yield.
All right. Just a reminder that BCE is a parent company of the channel under the Bell Media banner. Let's go to Chris in Delta, BC. Chris, go ahead.
Oh, good morning, Morella. Thank you for taking my call. Rebecca, I'd love to get your current thoughts on Agnico Eagle. It has really sort of surprisingly come down, even amidst this war in Iran and inflation pressures, et cetera. And I'm wondering if you see this as an attractive long-term entry. Thank you so much. I'll hang up and listen.
Okay. Where are you going with gold these days? It had that run. It's come off now. It hasn't been a safe haven so much lately for investors. They just announced today they're breaking ground in Nunavut for an expansion there.
Yep.
Do you like gold right now?
Do I like gold? Not really. Again, our focus is really as to try to invest as conservatively as possible. We do have Agnico Eagle in our portfolio. We bought it, when it was in the 60s and 70s. It had a 2% yield at the time. Obviously, Agnico was our preferred gold stock because it had the lowest geopolitical risk. Most of its mines are located in Canada, U.S., doesn't have those higher risk political countries like, Tanzania and things like that. And we slowly just, watched that stock, go from $70 to $300, and now, it's back to $250. What we've noticed is, you're right, gold used to be a safe haven. So, in the midst of geopolitical uncertainty, we would expect to see gold prices, go up, gold sector go up. We've now kind of seen that reverse recently because now gold is trading as a risk-on stock, and I think it's because the space just got very crowded. It's now become very speculative. So that being said, tread carefully, have a long-term time horizon. I'm, not adding to it now for our clients. Most of our clients are still overweight if they have a $70 cost basis. I added a little bit. At one point last year, it went to closer to 200. I did add a small position for clients that didn't own it. So for new clients that joined. It's hard to say right now because you're right. Gold prices are acting counterintuitive to what they should be. That being said, if you are going to own a gold stock, Agnico would be the one that I would own. So again, low 200s, I would maybe dip into, but, I wouldn't go all in. And it's not like I'm, enamored by gold prices at these levels.
Let's get to the next phone call then. We have on the line Bob in Toronto. Bob, go ahead.
Yeah, hi, Morella. Hi, Rebecca. Thanks for taking my call. Rebecca, Northland Power took a dive about a month and a half ago, or thereabouts, and it rebounded nicely. And I'm just wondering what your thoughts are about the future of this company and if you think the stock will go much higher. Thanks a lot for your response. I'll listen to you.
Thanks for the question. Okay, it did do that deep dive at the end of last year, sort of crawling back since then.
Yeah, this is a stock that Ryan Bushell, my partner, and I, we struggle, or we are. This is one of the ones that we may be on different pages, but again, same long-term perspective, maybe, how to get there. We have some differing opinions. So we owned it prior to that big fall, when they cut their dividend, and they basically had a whole reset at their investor day. And, we didn't like what they had to say, essentially. We still feel that dividend cut was unnecessary. It was a long-term decision to, fix a short-term problem with the Hai Long offshore wind project in Taiwan. We feel like they do have some risky assets, whether it's in Spain or Colombia, some of the projects were not going as well as expected. They're going to have to monetize at one point some of the long-term contracts they have off of some of the first offshore wind projects in the North Sea are coming off, and spot pricing is lower than expected. So lots of issues. New management team, Christine Healy, we think she's doing as best as she can. I think a lot of the issues happened with the previous management team. So that being said, obviously the stock was completely washed out at $16. So Ryan and I made the decision we're going to hold on to it. Now the question is, at what point do we exit, and if we exit? So, I was probably in the camp of wanting to exit when the stock got to about $20. And I'm like, okay, our losses are more minimal now than they were. It was obviously washed out at 16. It's now climbed back up to 20. And he said, let's hold on to it. Now, for now, he was right, because subsequently it's now traded through $20. It's at, 23 something. They just reported earnings. I think the stock was down, but the quarter was good, because at the end of the day, we were looking at those projects. They have Baltic Power in Poland, and they have Hai Long in Taiwan. Both of those projects are, on time, on schedule. That's what we're looking for. I think investors are now thinking more, what's their growth beyond those two projects? Again, new management team, they're going to really have to prove themselves after what we went through last year. I'm not sure if it's going to be a long-term hold for us. Most of our stocks that we own, we want to own them for a minimum 5 years, if not forever. This is the first time that we've really been tested in terms of their long-term plans, but we're going to, wait and see. We probably have to have a few more conversations with management to get an idea of what their future plans are, but we're waiting it out for now, and we'll see. We'll see from here. But if I could guess, I don't think we're going to own it for in the next year.
Let's get to the next caller. We have Paul on the line in Edmonton. Paul, go ahead.
Hello. Yes, I own ARC Resources. And now I understand Shell is going to buy ARC out for $32.80 a share. If we do not want to own Shell because of their apparent lack of short reserve life, should we sell ARC at the present price of $31.85 today, or wait until the buyout to go through, then sell ARC, or then sell Shell shares? What do you think?
Thank you for the question. Is there a general rule of thumb there if a company's being bought, when is the best time to sell?
There's different, methodologies. Every management team is going to do something different. For us, we would have normally waited until the deal gets closer to completion and then just kind of waited for that conversion. In this case, we're probably not going to. We don't want the Shell shares. We don't want to have to deal with the FX. We have other energy names that we prefer. So in this case, one thing to remember, because I also have that 32.80 in my head of what the initial takeout was, but it's a 75% Shell stock, 25% cash. So that is a moving target depending on what Shell prices are. So you may not get that 32.80. That being said, it's about $1 off from that now. What we did is the day that the merger was announced, we added a small position of Tourmaline. So we went from our favorite, gas company to our second favorite gas company. We kept ARC for now. We are most likely going to sell it prior to the deal closing. Not sure when that's going to be, maybe in the summer. The problem is where are we going to put cash? So we're just trying to figure that out. We do feel a lot of the market is expensive. A lot of the areas that we're interested in are trading at all-time highs. So until we could find a place to safely put that cash, I think we're better off earning that ARC dividend than we are sitting in cash yielding 2%. But we are going to sell it before the conversion.
Let's take a quick break. We're going to be back with Rebecca, Newhaven Asset Management, taking your questions on Canadian stocks. Here's how to reach us. Back in a moment. Welcome back to Market Call. Frank's on the line in Huntsville, Ontario, with his question today. Frank, go ahead.
Oh, hi. I was thinking of buying TD or Royal Bank. I'm just not sure if this is a time to buy. They've gone up so much in the last 1 or 2 months. I am thinking of buying for long term. Or I was just thinking, should I buy now or wait till the earnings come out, I think next week? So which one to buy and whether I should wait for now or when the earnings come out next week.
Okay, thank you for the question. TD's got about a 3% dividend, I guess. Royal Bank. He's looking at it longer anyway. But if you can compare the two.
Well, it's not even comparing the two. It's more like, should we get into either of them or none of them?
Point,
yeah,
yes.
at this point. I'm going to give you my opinion, but I'm also going to preface by saying I've been wrong about the banks for the past year because I've been saying that banks have been expensive for over a year, and I'm still wrong on that. The more wrong I get, eventually I'll probably be right. But, banks all generated, between 30 and 50% last year. And then some of these banks are up another 20% this year. What I have seen based on analyst expectations for this quarter is that these stocks are now priced to perfection. They are trading well above their historical average. And I would probably wait because generally what we see is when stocks are priced to perfection, they are more susceptible to larger falls if they don't meet expectations, even if it's by a little bit because their valuations are so high. The other thing, I was reading some analyst notes about what they expect in the quarter. And it's gotten to the point, it's almost like all the banks are looking for, because the underlying banking business is slowing or it's, just performing okay, they're looking for any other levers to pull to increase their earnings on a short-term basis. Last year, we saw them release a lot of their provisions for credit losses back into earnings. That was a temporary boost. In my opinion, that's a low-quality beat. This year, what I've been seeing, they haven't done that yet, but what analysts are saying is, let's see which banks have the most branches that they're able to close to be able to save money. So if your only growth aspect is being able to save money by closing branches,
yes.
you're basically, shrinking to grow. I mean, how much more of this can go on at these valuations? So I'm holding off. I haven't bought any banks this year, so I've been holding off. Again, I think eventually I'll be right, but I haven't been for the past year.
Yeah, Royal the average is 210, and it's up to 253 today. Okay, let's go to the next caller, Kevin in Toronto. Kevin, go ahead.
Thanks for taking my call. Rebecca, I'm looking at Maple Leaf Foods. I have a position in it. I'm just wondering if I should continue to hold. Thank you.
Thank you for the question. Maple Leaf Foods, is this more of a defensive play, would you say, Maple Leaf?
It is a defensive play. I think a sector that we are lacking a little bit in is the staple side. I mean, we basically have, the grocers, and we have a handful of these type of companies, like these, meat producers, and that's pretty much it in the staples space. I would say Maple Leaf Food has been a turnaround story. Margin improvement has been good. There has been that trade up story. It has come off. It's come off along with the other staples. And if you stay on, watch the show till my top picks, I'm going to give you another staple that we like a lot more than Maple Leaf. It's also come off. But the difference is that Maple Leaf Foods has a brand risk. There's like a reputational risk if something happens that, this other company doesn't have. We feel this other company has a little bit more growth. But that being said, I don't see a problem with Maple Leaf Foods. If you own it, you can keep owning it. I mean, the dividend yield is above 2.5%. And never thought I would say it, but 2.5% is not bad in this kind of market with valuations, through the roof. They did spin off their pork business. So again, they have been able to, extract some value from there, but no problem with owning it. We just have another one we prefer.
Let's get to Sylvain on the line then in Montreal. Sylvain, go ahead.
Yes, good afternoon, ladies. Look, I'm just wondering about Nutrient, NTR. What do you look for the next 2-3 years? Thank you.
Okay, thank you for the question. This one, a little complicated, right, with what's going on with the Strait of Hormuz. And right now, there would be a demand for fertilizer. So how are you looking at this?
Absolutely. And I think this is a common theme that I'm seeing, not for the stock Nutrient, but just Canada in general. I'm hoping that we're starting to see a resurgence of, Canada is a country that has, goods and material that people want. We are a low geopolitical risk area. We have all these minerals in the ground, and I'm hoping that we see that Canada can materialize this and see the benefit. So with regards to Nutrien, I don't love commodity price businesses, and Nutrien is, but the reason why we own Nutrien is because that dividend that you get is paid from their retail business. So they actually have, an agricultural retail business that they sell to. And that's what covers the dividend. That's not necessarily, that doesn't have the commodity exposure. What's causing that volatility in the stock price is that commodity-based business, as you mentioned. Strait of Hormuz is blocking other fertilizers. So that's where we're seeing, when Trump makes a tweet that the strait is closed, and then you're going to see, Nutrien stock go up, and then you see all of a sudden there's a ceasefire, and then the stock goes down. Those are all short-term noises. We like Nutrien for the longer term if you can get in at a reasonable price. So on the days where Trump tweets that the war is over and the stock is down 8%, I think that's a great opportunity to buy it. We own it for the longer term. We've owned it at around $70, then now it fluctuates, above and below 100 around. But again, we own it. We like we look at long term, and we look at, population growth. The need for agricultural fertilizer keeps growing. And so we like it for that. We like it for the retail business. We like it for their dividend that they keep increasing. And, we look at the commodity fluctuations as just, a good or bad entry point.
Okay. Let's go to an email from Robert. Your thoughts on RioCan, please. Shopping centers in the country. Where are you on this space? You guys own REITs?
So we do not own REITs. For a long time, we felt valuations were high. Yes, they always had the good dividend yield, which we like, but we always felt that there was a lot more growth by owning the pipelines, utilities that had, let's just say, similar dividend yields, but a lot more growth. And it's funny because now we've seen that growth, like that capital appreciation in the stock has happened. And it's funny because at one point, I think it was last week, I started looking, I'm like, we're not running out of dividend yield, but our dividend yield on our portfolio has significantly come down in the past year, not because the dividends have been less, but because price appreciation has been so high in the stocks that our dividend yield has decreased. So where could we find that dividend yield? And the answer is REITs. So I'm starting to look at it now. RioCan is not a bad REIT. So it's gone up a lot recently, but if you actually look at a 5-year, if you go longer, it's pretty much flat on a 5-year basis. The stock really hasn't done anything. There, you can see it's pretty much flat. But good dividend yield above 5%, 60% payout ratio. They have a high occupancy, resilient grocery anchored business, and there's a high lease renewal. So we like RioCan, like there's nothing wrong with it. I just need to do a little bit more research before if we are gonna enter the REIT space. I would wanna do a little bit more research first because, I am concerned there has been a slew of retail closures in Canada. If you think the Bay, Toys R Us, things like that, I'm not exactly sure what's happening in that space because I don't follow it so much, but I do think it is a good place, one of the only places you can get, plus 5% yield right now without a risk of cutting.
Let's take a quick break on that now. We're going to come back with Rebecca's past picks. That's coming up next. All right, time to have a look at past picks from Rebecca from May 15th of last year. So a year ago, at the time, she chose CNQ, Canadian Natural Resources, at $43.15. Now to $67.32, so 56% upside, 62% total return. Clearly, you've held on to it. Why? Do you remember why you picked it last year?
I could tell you why I've picked it for the past 5 years.
Okay.
It's one of those stocks that if you allowed me to pick it every single time, I would. I'm probably going to own this stock for the next 30 years, if not more. I liked CNQ when oil prices were $60. The fact that oil prices are now $100 is just a bonus to me. I mean, if anything, it actually makes it a little bit more expensive to own because valuations have gone up. But CNQ is making money. They have one of the most disciplined management teams. They have a huge long life of their oil sands, decades of production, low decline. They're one of the few energy companies that have a dividend record as strong as they do in terms of never having had to cut the dividend, because they are making money even when oil prices are $50, $60. The fact that they are making, more money now is great. They get to, pay back more, do more buybacks, maybe increase their dividend a little bit more. But they are long-term investors in their assets, and we are long-term investors in CNQ. And so that's why I like the name so much, because our disciplines are very much aligned. And again, like the stock price has now run up to $67, but I was buying it, I think a week or two ago. It went all the way back to 60. I bought some more. I liked it better when it was yielding 5.5%. It's now, yielding less than 4%. But again, to own the premium energy stock in Canada for the most premium energy company and assets, absolutely, there's no wrong time to buy it.
Let's get to your next past pick then from last May. K-Bro Linen, KBL on the TSX at 34.64 to 39.51 today. So 14% upside, 18% with total return. I always find this company fascinating because they do, laundry essentially. And I'm just wondering how you look at it. How did it even get on your radar, this one?
It is
because they're out of the UK, right?
No, they're actually Canadian, but now they've now done their second acquisition,
which was the UK.
Which is UK.
Okay.
So now about 50% of their business is UK, but 50% is still Canadian. I can't take credit for finding it. It was, Steve Moore, the founder of Newhaven. He put us onto K-Bro Linen, and it's by far the smallest cap stock that we own. And we generally wouldn't look at a company that has such a small market cap. But, one, you look at the business and it's, as boring as you get, which we love, recurring defensive business. You're right, they do laundry. Half of the laundry that they do is for hotels, a little bit more cyclical. Didn't do so great during COVID times, but the other half is healthcare. If you think about the laundry that's needed for hospital beds, surgical equipment, they do all that. That's a lot more resilient. And that's the business that's actually been growing. The acquisition that they did in the UK was more heavily hospital-based. Again, it's a great business. They did that transformative acquisition in the UK, Star Mayan. And there's a lot of synergies to be had, I think, in the next 12 to 24 months. I think management is being very conservative with their numbers. And, it helps, I think, the management, CEO, CFO, both women, both phenomenal. Every time you have a conversation with them, they are great leaders. And it's definitely a name that we would like to own. I do think that it potentially can get taken out by one of the larger guys in the US, but I hope it doesn't. I just hope it continues to do what they're doing and growing. And I hope that eventually the stock price, I think it's up, 18%, but I think it should be up more considering what they've been doing. And I think it's a matter of time before other investors start to
notice it.
Get to notice it, exactly.
Okay, that was K-Bro Linen. Let's get to your third pick, Pembina Pipelines on the TSX PPL at 52.49, 67.33 today, so 28% upside, 34% total return. I imagine you're still in this.
Just like CNQ, I'm always going to be invested in Pembina, I think. They do the oil and gas pipelines as well as processing and fractionation. Again, we are very positive on growth in the sector, specifically on the gas side with LNG exports, and they have a big exposure to that. And they also have a dependable dividend with lower volatility than your typical oil producer. Lots of their contracts are long-term based or fee-for-service, and that's what pays that dividend, and that's why that dividend's able to grow. So we're happy to own it. Most of our clients got topped up at $51 and happy to see it at $68.
Let's take a quick break on that note. We're going to be back with Rebecca and your phone calls and emails when we come back. Stay tuned. Welcome back. Alan's on the line in Toronto with a question today. Alan, go ahead.
Hi there. I love the railroads. Could you give me your opinion on CP Kansas?
Okay, thank you for the question. Pretty good railroad, maybe suffered during times of lower trade in the last year, but what do you think?
Yeah, all the rails and transport companies have been suffering through one of the greatest freight recessions. I think it started in 2022, post-COVID. And the question really is that over or not? And then the other question I also wonder is, rails are also more cyclical towards, the Canadian economy. And so where are we in the economic cycle? I mean, I feel like we are getting closer and closer to a recession. I feel like a broken record because every time I say it feels like we're closer, nothing happens. But that being said, maybe a part of that's already factored into the rail price because they already had that freight recession for 3 years. The stock has really languished. Year to date, CP has, trended up. Between the two rails, I prefer CN to CP. The valuation differential is huge, and so is the dividend yield. So, the dividend yield of 2.5% versus less than 1%. CP is traded at a stronger valuation because of the merger with Kansas City. There was a lot of synergies baked in, and as a result, valuations were higher. Maybe we prefer the underdog. I'm not sure for better or for worse. We don't own any of the rails yet. We do think there is an opportunity. We almost bought CN back in December when it was around 130. There was I think one day it got to 129 and then it ran away from us, waiting for it to come down again. And then we would probably enter that on a long-term basis, but it would be CN and not CP, mostly for the yield and valuation. But again, both rails, offer that that valuable infrastructure, focusing on needs versus wants. Critical infrastructure cannot easily be replaced. So we like the industry in general, which just, we have a preference towards one versus the other.
Let's go back to the phone lines. Manny's in Mississauga, Ontario. He's got a question. Manny, go ahead.
Hey there, Rebecca. I want to ask you about Atkins Realis. What do you think about this company? Is this a good time to buy right now? And what do you think for the next 3 years, maybe?
Okay, thank you for the question. Atkins Realis, of course, sort of engineering. They've got, they've got good reach. They've got history. It is down, and I thought this was one of the stocks that would do well in the infrastructure build out. Is there anything holding it back?
Oh yeah, absolutely.
Okay.
If you think Atkins Realis is down, you should put up a stock chart of Stantec or WSP. All of the engineering firms are down, 20+%. That is just similar to the software stocks. They have that AI pressure of, is AI going to take over a lot of their business? So all of the stocks have suffered. All of the engineering firms have suffered. Atkins Realis is actually the one that's performed by far better than any of the other ones. I think it's actually flat or up year to date. And the reason why, there's really one answer to that, and it's because of their nuclear exposure. I mean, they have the unique rights of the manufacturing of the CANDU reactors. They have a lot of growth in the nuclear space. And so my opinion is, if you really want access to that growth, because at the end of the day, the growth engine for Atkins Realis is nuclear. If you want that, you can get it through other means. For example, we own Aecon. I mean, I hate recommending Aecon because it's like $45 when most of our clients owned it at, $16. But Aecon and Atkins Realis, they work a lot. They work together for a lot of these nuclear deals. One of them will do the engineering. The other one does the actual construction and refurbishments. Aecon also has these long-term contracts on these nuclear refurbishments and new builds, if there is going to be a new build on the nuclear side. So you can get that exposure to nuclear without having to take on the riskier part, which is the engineering space at risk of losing some of their business to AI? For example, WSP does a lot of acquisitions. The question is, did they overpay if AI is going to take over some of, and if those margins are going to come down? So again, we like the nuclear space, but I think there's safer ways to play it.
Let's go to an email then from Tony. Good morning. What does Rebecca think of Pet Value, PET-T, as an investment? Would it be good to start to pick it up or pick up a few shares? Pet Value has come off quite a bit. They did report earnings. There must have been some weakness there. Do you like Pet Value? Where do you put it? Is it a disposable category? Is it a staple? I mean, if you have pets, you have to feed them. You have to care for them.
So that's a great analysis, and that's exactly my thinking when I started looking into that. So this was actually one of the first stocks that I brought to Ryan's attention when I said I think we should get a little bit more exposure to the retail space, because that's where we were lacking. And we had a call with management, and we liked the company. It was at that time trading around $25, which was around the IPO price. What happened was the stock had soared a lot during the pandemic. Again, there was that whole pet boom, everyone was getting a pet. And then the stock had come off, as you could see there. So we started looking at it around when it had come off from, around $40 to $25. And we're like, is this reasonably priced? Because what we liked is that they were still growing, about 45 stores a year they were opening. They have a model where they have some corporate stores where they can do some product testing, and then they have some franchise stores, so they're not actually using their own capital to be able to grow. So we liked everything they had to say, but we knew that there was that fundamental risk, because you're right, you need to feed your pets, and food is a staple. But a lot of the margins were coming from the other side, which is the toys and all the, I call them tchotchkes, but like all the
leashes, the habitats, yes.
And that's where we're and they just reported last week, and it was I don't want to call it a disaster earning, but it was the market did not like those earnings, and we're seeing lower margins coming specifically from that space. And so the question is that pet boom over? I'm not sure. I'm glad we never initiated a position, because we are seeing it, even though there is a staple attribute to it, it does trade more like a discretionary stock.
Okay, let's take another quick break. Back with your phone calls and your emails for Rebecca in just a moment. Welcome back. Scott's been holding on the line. He's in Vancouver. Scott, go ahead.
My question's on Superior Plus. When I look at it, some people say it's really well positioned for the crazy weather, data centers, it pays a decent dividend. The naysayers say management's bungled acquisitions, they're losing customers because of bad service, and they've got too much debt. Where do you stand?
Okay, so this is a propane company.
Yeah. So yeah, exactly. They are a distributor of propane, and then with the acquisition, and I may be butchering their name, Centaurus. They purchased that in the U.S. and they do compressed natural gas. We have enough exposure to natural gas, and we've seen quite a bit of volatility in natural gas through weather-related events. And we start to see, like, through the shoulder seasons, natural gas prices, get below $1 in Canada, and then they spike up when the cold weather or super warm weather hits. Superior Plus is basically even more volatile. Like, propane is basically like natural gas, but even more volatile, highly weather dependent, lots of seasonal margin pressure. So it's not something we've invested in. The founder of Newhaven, Steve, he owns some Superior Plus. I believe he was hoping it was going to get taken out by one of the Brookfields, similar to how they took out Enercare. Mm-hmm. And I think he was hoping that happened. It didn't. They do have a good dividend. I believe they did have to cut their dividend because it was very high. I think it was maybe 1 or 2 years ago. You were right. Through that U.S. acquisition of Centaurus, they did sign a data center contract. So I think that's been positive for them. Again, if you can weather the volatility, I do think it's a stable business. I don't think it's a bad business. For us, it's a little bit too volatile. And again, because we have that exposure to natural gas, we just don't want to add that extra. We know it's more volatile than natural gas, and we prefer the growth in natural gas through LNG exports. And we just think there's more growth there.
Let's get to the next caller. Ray is in Lions Bay, BC. Ray, go ahead.
Listen, I really appreciate you guys and appreciate the program. Rebecca, my question is about Shopify. I am a longer-term investment, and I'm wondering what you think about Shopify.
Okay, thank you for the question. Very volatile. Software concerns, right, here?
Yeah, it's funny. It's only recently been very volatile. I mean, put up a longer-term chart. This thing is, it's gone through the roof. And, it's interesting because you are actually seeing exactly my point that I've been saying, for the past few years is that you could be a really great company that has a lot of growth. If your valuation is too high and you're priced to perfection, then you do have risk of that coming down. And that is exactly what happened with a lot of, there's only a handful of tech companies in Canada, and I think a lot of investors have flocked to it. So Constellation Software, Shopify, they've been the tech darlings. At one point, I think it was 2 years ago, Shopify was actually bigger in market cap than RBC, but had a fraction of the revenues. It was all valuation based. So right now, anything in the in the software sector has come down significantly. Some of them have been chopped in half, Shopify about 30%, because of the whole idea of AI can take over a lot of these software companies. And this is why we definitely prefer owning hard assets, not soft assets. Because at the end of the day, I don't think AI is going to take over a pipeline. AI is not going to take over a utility. But what is the actual value of Shopify? For example, if AI does come up with a software that is replicable and cheaper to install,
a business platform the same way that
similar,
Shopify, yes.
Then at the end of the day, Shopify's market cap is highly based on goodwill and intellectual property. If that goes away, what are their hard assets that are left? Again, it's been a great performer, but we are not risking client capital. We rather hard assets, even though returns may be, more muted. We're not looking for, a five bagger. We're just looking for consistent returns. We prefer hard assets versus a Shopify, which is mostly soft assets.
All right, that was for Ray. Let's take a quick break. We have new picks from Rebecca when we come back. Join us tomorrow for Market Call. Javed Mirza will be on the show, quantitative technical strategist at Raymond James. He'll take your questions on technical analysis. That's tomorrow. Let's get to new top picks from Rebecca. We're going to start with Premium Brands Holdings, PBH, on the TSX. What is it you like about Premium Brands?
So this is the consumer stock that I had mentioned as opposed to Maple Leaf. Stock came off. It was like doing exactly what it said it was going to do, reached $100, and then it just came down to the low 80s because of last quarter, a bad quarter. Really the quarter wasn't so bad. I mean, yes, there is, beef prices, so like their input prices are up. But if you look at it on a long-term basis, I mean, this is actually, there's very few stocks I'm all in on right now because I think valuations are so high in the market, and this is one of them. I mean, the value is so there. They've invested $750 million in capacity expansions in the U.S., and now that that's over, they're able to take on that growth initiative in the U.S. They've been buying more capacity. They've been selling non-core assets. They're doing everything they should be doing. There's no reason why the stock should be trading less than $100, if not more. So, yep, all in on this one.
Premium Brands. Let's get to your next pick. Brookfield Infrastructure Partners, BIP. .UN. What do you like about the infrastructure? Is this just on the build out expected in this country and others?
This is more a question of there's been, again, weakness because of a stock issue, not because of the fundamental underlying businesses. So on the last call, they were talking about merging, possibly looking at a unified, Brookfield infrastructure units versus the corp. And then we've seen a huge difference in the spread. So BIPC, the corp, has come down, 12%, and the unit trusts haven't. So there's this big disconnect of what happens if they merge. I think there's too much talk on that, not enough talk on what actually they're doing. And what it is that they are growing. They're recycling capital. They are one of the best of that. They are considered a utility in Canada, but they have the most diversified suite of assets versus any utility company in Canada, whether it's geographically because they have assets all over the world, or the type of assets. So they do have a lot of utility assets, but they do have growth in data centers. They do own airports and traditional ports and things like that. So it's basically like owning a private equity company through a Canadian listed security, and they have a good dividend yield, one of the few dividend yields in the 5% range, and we do think they're going to continue to deliver growth.
Okay, let's get to your last pick, CAE on the TSX. They have been sort of looking at themselves, deciding what to do. And what do you like about the company?
Yeah, so this is, again, one of the few names that we have that don't pay a dividend yield. So that means I'm very convicted on the fact that the stock price is undervalued. The stock has come off, and I think it's for the wrong reasons. It's basically gotten traded down along with the rest of the airline space. Again, with oil prices going up, there's the question of passenger traffic coming down. So all the airlines have been hit. CAE, that does a flight simulation on civilian aircraft, I think there's just because even if we do see a decrease in passenger traffic, that doesn't mean that flight requirements are going to go even less. Pilots are still going to have to train themselves. There is still a long-term secular trend that we need to hire more pilots over the next decade, if not more. So I think those longer-term secular trends are going to outweigh any short-term weakness that we're seeing as a result of higher oil prices. And then the other thing is they have defense.
I got to cut you out.
Oh, no, defense business. Good to have.
Thank you for joining us. Thanks for joining us on Market Call. We'll see you tomorrow.